The U.S. economy is expanding at a moderate pace and should grow at an annual rate of about 1.8% or higher. It's a modest but welcome forecast after a tough winter that saw the economy shrink between January and March. Fed Chair Janet Yellen says the weakness was likely temporary.
Despite the soft first quarter, the fundamentals underlying household spending appear favorable, and consumer sentiment remains solid.
Unemployment is projected to decline further from 5.5% to 5.2% this year. But until the economy meets the Federal Reserve's dual mandate of full employment and moderate inflation, Yellen says the Fed's policy of record low interest rates will remain unchanged.
The committee continues to judge that the first increase in the federal funds rate will be appropriate when it is seen further improvement in the labor market and is reasonably confident that inflation will move back to its 2% objective over the medium term. At our meeting that ended today, the committee concluded that these conditions have not yet been achieved.
But economists point to clues from the Fed's latest meeting that suggest committee members believe a rate hike will happen this year. Here's Gus Fauché at PNC Financial Services on Skype.
They do provide a graph that shows where members think the Fed funds rate is likely to end up at the end of 2015. And all but two of the members seem to indicate that they do expect at least one rate hike sometime this year.
The majority of analysts we spoke with believe a rate hike, the first in 9 years, could be announced as early as September. Among them, Bankrate.com bureau chief Mark Hamrick.
And that really represents a delay from what they had thought before, where we thought we'd be sort of staring that in the face here in the month of June. It's also worth mentioning that a quarter of our economic panelists think that the rate increase could wait until 2016.
The International Monetary Fund was among the groups urging the Federal Reserve to delay a rate hike until early 2016, citing the significant market volatility that would result from higher U.S. interest rates.
Thank you very much.
Arcega, VOA News, Washington.